Stop whatever you are doing and pay attention. March has just begun, and the market is already sending a warning. Not the kind of vague, recycled warning you see in headlines every week. This is a clear signal, a first day of the month message that only disciplined traders are noticing. Gold is moving. Volatility is creeping back. Geopolitical tension is escalating, and smart money is repositioning while most traders are still stuck on old patterns. If you think you can ignore this, you're already behind. Gold isn't just rising, it's holding structure. Every time it dips near critical levels, buyers step in. This isn't emotional retail buying. This is institutional positioning, measured and deliberate. Meanwhile, Bitcoin and other speculative assets are hesitating, failing to reclaim key resistance levels. This divergence is a powerful signal. Capital is choosing stability over risk. March 1st is always a critical day. Institutions deploy fresh capital, rotate exposure, and hedge uncertainty before most retail traders even notice. This month is no different. Geopolitical risk, sticky inflation, and uncertain policy are colliding in a way that affects nearly every asset class. And the first day of the month is already highlighting where capital is moving. Let's start with the macro picture. Geopolitical tension in the Middle East has escalated recently, with US and Israel military actions targeting Iranian positions. Markets don't just react to the headlines, they anticipate the consequences. Oil supply risk rises, energy costs climb, inflation expectations shift, and central banks must adjust policy forecasts. Gold sits at the center of this chain. Every layer of uncertainty increases its appeal as a hedge. Inflation remains a persistent background force. Recent producer price data came in hotter than expected, raising concerns about whether central banks can reduce rates aggressively. When inflation expectations remain elevated, defensive positioning becomes more attractive. Gold, already bolstered by geopolitical risk, benefits from this layered uncertainty. Meanwhile, equities are not collapsing, but they are not surging either. This is not panic. This is caution. And caution lasts longer than panic. The first trading days of a month often set the tone for capital rotation throughout the next few weeks. Traders who understand this can position themselves for the moves that most others will only see in hindsight. Let's make this practical. Gold's critical support zone is near 5,200. Buyers consistently defend this level, creating higher lows on pullbacks. That tells you institutional money is active, watching carefully, and ready to reinforce positions. The next breakout zone is around 5,300. If gold sustains above this area, trend-following capital could join, potentially pushing the price higher. But chasing blindly without observing structure is dangerous. False breakouts are common, especially in volatile environments. Bitcoin and other speculative assets provide a contrast. Crypto has struggled to regain resistance in the mid-60,000 range. If it fails to hold lower support near 64,000, further weakness in risk-on assets could follow. But if it breaks resistance decisively, temporary risk appetite could return. Observing divergences like these is how disciplined traders separate opportunity from chaos. The US dollar is another critical variable. Typically, gold and the dollar move inversely. But during heightened global stress, both can strengthen simultaneously, reflecting capital seeking safety and liquidity. When you see gold holding while the dollar also strengthens, that combination is a subtle but powerful warning signal. Ignoring it could be costly. Oil markets also reflect geopolitical and inflation dynamics. Prices have reacted quickly to recent tension, reinforcing inflation expectations and complicating monetary policy projections. That in turn strengthens the case for defensive hedging in gold and other safe haven assets. Understanding these chains of causation allows traders to anticipate moves before they appear obvious in price charts. Everything is connected. Geopolitics feeds energy, energy feeds inflation, inflation feeds rate expectations, rates feed capital rotation, rotation feeds asset movement. Those who grasp this chain have an informational advantage. Now let's get tactical. If you are a short-term trader, the focus is on reaction, not speculation. Watch how gold behaves after negative news hits. If it absorbs selling pressure and maintains structure, underlying demand is strong. Watch crypto's reaction to risk-off days. If it struggles to rally after positive headlines, sentiment remains fragile. These observations provide actionable entry and exit insights without relying on guesswork. Swing traders should monitor relative strength. Gold outperforming equities and crypto over multiple sessions signals a trend that deserves respect. Trends driven by macro rotation are rarely short-lived. They can persist for days or even weeks. Long-term investors must assess exposure carefully. Defensive allocation doesn't mean abandoning growth, but it does mean balancing risk during elevated uncertainty. The first day of the month often sets the tone for allocation decisions throughout the period. Ignoring signals on day one could compromise portfolio positioning for the entire month. Risk management cannot be overstated. Use defined stops, avoid oversized positions, and scale entries rather than committing all at once. Geopolitical markets can reverse quickly if narratives shift. Failing to manage risk in these environments can lead to catastrophic losses, even if your analysis is correct. Observe structure and volume. These are more important than headlines. Price confirms conviction. When gold, oil, and the dollar all move defensively, markets are signaling a shift. When crypto hesitates, it reinforces the cautious sentiment. Watching these dynamics allows you to act with clarity rather than fear. Let's talk scenarios. Scenario 1. Geopolitical tension escalates further. Safe haven demand could strengthen. Gold may accelerate higher. Crypto and equities could come under additional pressure. Scenario 2. Inflation surprises continue. Sticky prices reinforce the defensive thesis. Gold remains supported as central banks hesitate on aggressive rate adjustments. Scenario 3. Diplomatic or economic relief appears. Headlines ease, risk appetite returns, and rotation toward equities or crypto resumes. Gold could pull back slightly as defensive flows reverse. Scenario 4. Complex layering. Some geopolitical risk eases, but inflation remains sticky. Equities rebound modestly, crypto remains fragile, gold stays firm. Positioning is nuanced and requires observation, not speculation. These scenarios highlight why adaptability is your edge. Markets are not about predicting headlines. They are about observing behavior, interpreting positioning, and acting decisively. This is where most retail traders fail. They see a spike or dip and assume it's a trend. They see a headline and react emotionally. Professionals watch structure, relative strength, divergences, and capital flows. They enter or exit based on confirmed signals, not assumptions. March has begun with a market warning. Not a scream, not a crash. Just a signal that smart money is moving, positioning defensively, and preparing for a month of heightened sensitivity. Your advantage comes from awareness, observing, analyzing, and adapting. Acting with discipline rather than reaction, respecting structure, managing risk. This is the essence of trading in transitional environments. Patience, clarity, and precision. Miss the signal, and the market moves past you. Follow it with discipline, and you position yourself for opportunity. So ask yourself, are you reacting to yesterday's headlines, or are you observing today's signals? Are you trading based on fear, hope, or evidence? Now is the time to act wisely. Not hastily, not emotionally, but with informed judgment. If this breakdown gave you clarity, insight, or a better understanding of how markets are positioning at the very start of March, here's what to do next. Subscribe to Market Crux. Turn on notifications. Stay ahead of market shifts. Watch for tactical levels, divergences, and signals that define the month ahead. Comment below with your positioning: defensive, cautious, or risk on. Engage in the conversation, learn, and adapt. March has begun, and the market is already moving. Don't wait for the noise to catch up to you. Position, observe, and trade with clarity. This is your warning. The market is sending it. Will you act?